All right, so we're going to be looking at some accounting today. I got bored studying my own, but I still got to do this since I figured I'd switch it up and do something a little different. Valuing accounts receivable. That's what we're going to be covering. C1, describe accounts receivable and how they occur and are recorded. A receivable is an amount due from another party. The two most common receivables are accounts receivable and notes receivable. Other receivables include interest receivable, rent receivable, tax refund receivable, and receivables from employees. Accounts receivables are amounts due from customers for credit sales. Exhibit 9.1 shows amounts of receivables and their percent of total assets for some well-known companies. Exhibit 9.1, accounts receivables for Microsoft shows 48,688. That's in millions, so it's be 48,688,000,000. Nike's at 4,131,000,000. Tesla is at 3,508,000,000 and Intel at 3,402,000,000. These are the accounts receivable as a percent of total assets. Sales on credit. Credit sales are recorded by increasing or debiting accounts receivable. The general ledger has a single accounts receivable account called a control account. A company uses a separate account for each customer to track how much that customer purchases, has already paid, and still owes. A supplementary record has a separate account for each customer and is called the accounts receivable ledger or accounts receivable subsidiary ledger. Exhibit 9.2 shows the relation between the accounts receivable account in the general ledger and its customer accounts in the accounts receivable ledger for TechCom, a small wholesaler. TechCom's accounts receivable reports a $3,000 ending balance for June 30th. TechCom has two credit customers, CompStore and RDA Electronics. Its schedule of accounts receivable shows that the $3,000 balance of the accounts receivable account in the general ledger equals the total of its two customers' balances in the accounts receivable ledger. Exhibit 8.2 shows the general ledger and the accounts receivable ledger before July 1st. You can't see that, but I can. To see how to record accounts receivable from credit sales, we look at two transactions between TechCom and its credit customers. See Exhibit 9.3. The first is a credit sale of $950 to CompStore. The second is a collection of $720 from RDA Electronics from a prior credit sale. So we got July 1st, a debit to accounts receivable from CompStore and a credit of $950 to sales. This is a record of credit sales. On July 1st, we also have a debit to cash of $720 and a accounts receivable credit of $720 to RDA Electronics. This is a record collection of credit sales. We omit the entry to debit costs of sales and credit inventory to focus on the sales and receivables. That's for this example. Exhibit 9.4 shows the general ledger and the accounts receivable ledger after recording the two July 1st transactions. The general ledger shows the effects of the sale, the collection, and the resulting balance of $3,230. These transactions are also shown in the individual customer accounts. RDA Electronics' ending balance is $280 and CompStore's ending balance is $2,950. The $3,230 total of customer accounts equals the balance of the accounts receivable amount in the general ledger. Exhibit 9.4 shows a general ledger and the accounts receivable ledger after July 1st. Just want to scan this. All right, and then sales on bank credit cards and mobile payments. Most companies allow customers to pay using bank or third-party credit cards such as Visa, MasterCard, or American Express, and debit cards. Many companies also accept mobile payments through Apple Pay, Google Pay, PayPal, Venmo, and Cash App. Sellers allow customers to use credit cards, debit cards, and mobile payment services for several reasons. First, the seller does not have to decide who gets credit and how much. Second, the seller avoids the risk of customers not paying. This risk is transferred to the bank. Third, the seller typically receives cash from the bank sooner than it had granted credit directly to customers. Fourth, more credit options for customers can lead to more sales. One point is that JCPenney reported third-party credit card costs exceed $10 million. The seller pays a fee when a card or mobile payment is used by the customer, often ranging from 1% to 5% of sales. This fee reduces the cash received by the seller. If TechCom has $100 of credit card sales with a 4% fee, the entry follows. Some sellers report credit card expense in the income statement as a discount subtracted from sales to get net sales. Other sellers report it as a selling expense or an administrative expense. In this text, we report credit card expense as a selling expense. We have a table here that shows on July 15th, there's a debit to cash of $96, credit card expense of $4 debited, and a sales credited of $100 sales credit, a credit of $100 to sales, sorry. Record credit card sales less than 4%, credit card expense. We omit the entry to debit cost of sales and credit inventory to focus on the credit and credit card expense. We have a box here titled Decision Maker, an entrepreneur. As a small ski resort retailer, you are considering allowing customers to use credit cards. Until now, your store accepted only cash. What analysis do you use to decide? The answer is that this analysis must weigh benefits versus costs. The main benefit is the potential to increase sales by attracting customers who prefer credit cards. The main cost is the fee charged by the credit card company. We must eliminate the expected increase in sales from allowing credit cards and then subtract 1, normal costs and expenses, and 2, credit card fees from the expected sales increase. If analysis shows an increase in profit, the store should probably accept credit cards. Bingo! Make that money. Need to know 9.1 credit card sales. Loading scripts. I don't feel like waiting. Prepare journal entries to record following transactions from the realtor. Blah, 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 blah. Okay, so on January 2nd, we sold merchandise for $1,000 that had cost $600 and accepted the customer's AA bank card. AA charges a 5% fee. On January 6th, we sold merchandise of $400 that had cost $300 and accepted the customer's Visa card. Visa charges a 3% fee. It's spelled V-I-Z-A here. I wonder if the author didn't know how to spell it or if they just intentionally did that for copyright issues. Anyway, doesn't matter. Solution. On January 2nd, we have a debit of $950 to cash, a debit of $50 to credit card expense, and a credit of $1,000 to sales. On January 2nd, we have a debit of $600 to cost of goods sold, a credit of $600 to merchandise inventory. On January 6th, we have a debit of $388 to cash, a debit of $12 to credit card expenses, and $400 is credited to sales. On January 6th, the cost of goods sold is debited for $300 and merchandise inventory is credited for $300. All right, that was a quick section. Cool. Bam, we're done with that section. And I'm just going to do another video. I'll go ahead and delineate the videos so that way they're separated by topic, category. Where the hell is my YouTube page? Oh, sorry, I remember. Here we go. And we're done with this one. Yay.